PantheonAI presents Market Slips, Ethereum Soars 4.5%, Fed Eyes Consumer Slowdown, Tariff Rhetoric. Welcome back to the PAI Morning Briefing.
Good morning, everyone. It's May 9th, 2025, and we've got a jam-packed briefing for you.
Absolutely. We're going to unpack yesterday's market moves, dive into some really significant economic trends we're seeing, and explore a range of news stories that are genuinely shifting the financial landscape right now.
Grab your coffee, settle in. We're about to get into it.
Let's kick things off with a quick market overview from yesterday. It was a bit of a mixed bag, wouldn't you say?
Definitely. The S&P 500 closed at roughly 5,668, down just a hair, nearly 0.2%.
Yeah, not a huge move there. And the Dow Jones Industrial Average trailed a bit, around 41,307, slipping by almost 0.23%.
Right. And the Nasdaq Composite, which, is often our proxy for tech, registered nearly 17,958, marking a decline of about 0.35%.
Even the Russell 2000, tracking those smaller cap stocks, wasn't exempt from the pressure. It traded at roughly 2,027, with a minor drop of about 0.19%.
So, a little softness across the board for the major indices yesterday.
Exactly. Now, switching gears slightly to the digital currency arena, this is where things got interesting.
Oh yeah? What happened?
Bitcoin traded at approximately $103,000, showing a modest decline of almost 0.08%.
Okay, so Bitcoin was kind of flat, maybe slightly down like the indices.
But Ethereum really stood out with a robust performance. It traded at around $2,307 and surged by roughly 4.5%.
Wow, that's a significant divergence. You don't see that every day between those two giants.
It is intriguing. While Bitcoin seems content hovering near its support levels, Ethereum is clearly capitalizing on some underlying momentum, something to keep an eye on.
Definitely. So, moving from these numbers to what they might mean. What are these movements suggesting about the broader economic environment?
Well, the analytical eyes of experts have really been focused on consumer behavior lately, and the emerging signals hint at a slowdown in spending.
I've heard that. Federal Reserve official Williams actually mentioned there appear to be early signs of consumers starting to pull back.
Right, and that sentiment is being echoed across multiple reports. This shift in spending behavior, even if it's just starting, could signify a deceleration in economic growth.
And that could potentially lead to a reevaluation of monetary policy down the line, couldn't it?
Exactly. While small changes often happen, the potential impact of subdued consumer activity could be significant, especially if these trends continue over the next few quarters.
That idea of tapering off in spending, it seems to coincide with another curious trend. The tourism and travel sector is showing tangible signs of contraction.
Oh, absolutely. Expedia, for example, has reported that Americans are flying less, and Canadians have notably scaled back on U.S. visits.
And their stocks took a hit after a revenue miss and a downbeat outlook for bookings, right?
They did. It's not every day you see major travel stocks falter in the face of what felt like a resilient economy. But when consumer confidence shifts, every sector feels that breeze.
That makes sense. Now, these stories, they also overlap a bit with geopolitical and policy-driven shifts.
They really do. President Trump continues to make headlines with his rhetoric on unilateral deals, hinting that some tariffs might well be on the rise.
According to Goldman Sachs chief political economist Alec Phillips, right? He warned about this.
That's right. He warned that these potential tariff hikes could affect not just major trading partners, but also ripple through different market sectors. It's a reminder that policy signals, even those that seem politically charged, can have far-reaching, sometimes unpredictable, effects on markets.
Absolutely. Speaking of market commentary, Michael Hartnett of Bank of America, who's known for his occasionally unconventional but often spot-on calls, has been pondering the state of U.S. equities as the year started.
Yes, Hartnett. His concerns center on the possibility of a stock market correction and the allure of alternative assets like bonds, international stocks, or even precious metals.
His perspective is definitely worth noting, especially when we see differential performances across various asset classes, like we just discussed with Bitcoin and Ethereum.
It reinforces that idea that investors might need to maintain diversified portfolios to hedge against any unforeseen shocks.
Good point. So, looking at the broader global implications, there seems to be a tangible mix of caution and opportunity in the air.
Definitely. While U.S. domestic indicators point to mild declines across major indices, the digital currency space is offering that divergent narrative with Ethereum's rally.
And international markets? They seem to be watching closely, balancing corporate earnings, currency fluctuations, and political developments.
Exactly. And those shifts in U.S. consumer spending we mentioned? They could potentially reverberate globally, dampening export demand if American consumers remain reserved.
Plus, any hint of rising tariffs not only affects bilateral trade, but could spark retaliatory measures, adding another layer of complexity to international forecasts.
Right, so let's just delve a little deeper into some of these key stories making the rounds today. First up, those repeated reports. Yes, multiple coverage from various media outlets about early signs that consumers might be scaling back their spending.
It's not just a one-off mention. A top Fed official like Williams making this point clear makes it a recurring theme in today's economic discussions.
The implication of a slowdown here is that we might see a trickle-down effect in areas like retail sales, dining out, even big-ticket purchases.
So for the everyday investor, this might be a signal to look at companies less reliant on discretionary spending or consider shifting towards sectors that traditionally do okay in slower consumer environments.
Precisely. Next, back to the travel sector. That Expedia story really resonates as a cautionary tale.
When a revenue miss coincides with a dip in consumer travel interest, it really underscores that point that even industries with historical resilience can face undercurrents of economic change.
Travel and leisure had been on such an upward trajectory as economic confidence soared in previous years. But the message is clear. The era of seemingly perpetual growth might be encountering its headwinds.
And the impact isn't just on airline stocks and hotels, right? It's felt in all those ancillary sectors that support tourism.
Exactly. So if you're invested in travel, hospitality, or related services, this is one story you'll likely need to monitor closely.
Okay, and then there's that saga of President Trump and his talks about unilateral deals and rising tariffs. Those repeated warnings from Goldman Sachs' Alec Phillips create a palpable sense of tension.
They do. The very thought of tariffs creeping upward forces companies to revisit their supply chain strategies and rethink pricing. If tariffs escalate, we could see a slowdown in trade flows, increased production costs, and a possible dampening effect on corporate profits.
These factors, they really urge investors to be cautious, especially if you're in industries like manufacturing or technology, where global supply chains are integral.
Definitely. And we can't overlook the voice from Bank of America in the form of Michael Hartnett's latest comments.
Hartnett, who, as you said, sometimes dances on the edge of conventional wisdom, seems wary about the future trajectory of U.S. equities.
His contrarian stance is a good reminder that, while equity markets have been rallying for a while, complacency should really be met with a healthy dose of caution.
His view favoring investments in bonds, international markets, and even gold really invites us all to consider a diversified approach in anticipation of potential market volatility.
Right. Now, let's look at sector-specific analysis. Tech, energy, and finance. That trio that often forms the backbone of our market discussions.
Okay, let's start with tech. It's always vibrant, but it tends to be more sensitive to fluctuations in consumer behavior and macroeconomic trends.
And with consumer sentiment showing signs of caution as spending eases, tech companies might face headwinds in the short term. However, on a positive note, robust investment in research and innovation often provides a buffer.
That's a good point. Even if the ride's bumpy, innovation keeps the engine running, ensuring breakthroughs aren't totally constrained by temporary slowdowns.
Exactly. And with Ethereum's price rallying notably, there might be more than a little momentum brewing in the blockchain and crypto-adjacent tech subsectors.
Interesting. How about the energy sector?
There, the backdrop remains one of cautious optimism balanced with supply concerns. Global energy demand typically tracks economic activity, so a slowdown in spending could translate into modest pullbacks.
But you've got the shift towards sustainable energy and the political will to invest in renewables bolstering the sector.
Right. Investors are watching that transition closely. The narrative there is as much about geopolitics and environmental stewardship as pure economics.
And finally, finance. In a year with persistent debates over monetary policy, the finance sector is just buzzing with discussions on the Fed's next moves.
With that repeating note that consumer spending might be declining, financial institutions are simultaneously gearing up for potential fluctuations in loan demand and credit quality.
It's no secret banks are among the first to feel the sting when the broader economy slows. But they also benefit from volatility when new opportunities for lending and refinancing emerge.
Michael Hartnett's perspective, again, offers an intriguing counterpoint. While some remain cautious about equities, the world of bonds and alternative assets is opening up new possibilities for value-seeking investors.
That's true. So, shifting our lens back to global market implications, it's essential to recognize that what happens in the U.S. rarely stays confined within its borders.
Absolutely. The signals coming from American consumer behavior, policy statements, key economic indicators, they have the potential to influence markets across the Atlantic, throughout Europe, even into Asia.
The expectation of tariffs, for instance, can unsettle trade markets globally, prompting central banks and governments to reassess their own strategies.
Investors worldwide really must be attuned to these risks, because small perturbations in one major economy often set off a domino effect around the globe.
Okay, let's move into our Expert Insights segment. What are some predictions we might venture for the near future?
Given the current landscape, you could argue that markets are in a state of cautious equilibrium. They're testing both the levels of consumer demand and the boundaries of government policy.
And that dichotomy between Bitcoin's steady performance and Ethereum's buoyant climb, it suggests that while traditional assets might be under pressure, digital assets, particularly those supporting smart contracts and decentralized finance, might be starting to capture investor imagination anew.
That's a great point. So what does this all mean for you, the investor?
It might be time to re-examine your portfolio allocations. Do you have too much exposure in sectors vulnerable to consumer spending slowdowns?
Or do you hold a diversified mix that includes alternative assets that could perform well in a shifting economic landscape? There's a delicate balancing act required.
Perhaps the best strategy is one informed by a blend of caution and daring. Markets are perennial puzzles, after all, requiring both thoughtful analysis and a touch of intuition.
Well said. So in closing, here are some key takeaways we can all mull over.
First, though major market indices showed only minor declines, they are signaling underlying headwinds we really can't ignore.
Second, the reports on slowing consumer spending and the travel sector's challenges highlight a noteworthy shift in economic behavior that might portend a broader slowdown.
Third, the warnings from political figures and economists about rising tariffs remind us that policy decisions can induce rapid changes in market dynamics.
And lastly, that contrasting performance of Bitcoin and Ethereum, it invites us to consider the ongoing evolution in the digital currency space, which continues to redefine investment opportunities in radical ways.
Absolutely. Now, before we wrap up today's briefing, let's infuse a bit of humor into our discussion.
Oh, here we go.
You know, sometimes I wonder if the market is like your coworker on a Monday morning. Quiet, bit grumpy, not particularly forthcoming with smiles or interesting news.
Haha, I know that coworker.
But then, just when you think it might stay mute, it surprises you with a burst of unexpected movement, much like that coworker who suddenly shows up with a freshly baked batch of cookies.
Oh, that's good. So who would have thought the S&P 500 could be that colleague?
Exactly. Of course, no one's baked cookies here today, but if the markets did mirror the subtle shifts we're experiencing, we might be in for a treat, or maybe a wake-up call.
Very true. That brings us to some thought-provoking questions for you, our engaged audience.
How might you adjust your position if consumer spending indeed continues to backtrack?
Are your portfolios diversified enough to weather these potential storms? Or will you need to realign your asset mix?
And lastly, what do you make of the contradictory signals in the digital currency domain? Will Bitcoin maintain its steady pace, or could Ethereum's momentum signal a transformative shift in investor sentiment towards digital assets?
These are all questions worth pondering as you strategize for the coming weeks.
To wrap things up today, we want to thank you for joining us on this extensive journey through the markets, economic news, and sector analysis.
We've covered a lot of ground, from the calm seas of the major indices and our digital currencies to the turbulent waters of consumer behavior and geopolitical maneuvers.
As always, PantheonAI remains your trusted information co-pilot, dedicated to helping you chart a course through the complexities of the financial world.
Keep these insights in mind and apply them to your own investment strategies. We invite you to come back for the next episode tomorrow for more in-depth analysis and updates.
And feel free to ask questions as needed, whether it's about market positioning, economic trends, or even peculiar anomalies in the digital currency realm. Our AI co-pilot is here to assist.
Remember, learning shouldn't feel like a full-time job.
Exactly. Thank you for listening, and until next time.
Stay curious, stay informed,
and happy investing. Pantheon AI, your information co-pilot.
Because learning shouldn't feel like a full-time job. Take care and see you next time.